All right, everybody, what's going on? It is another week, and we made a lot of plays, so let's go ahead and get into it. The first thing is if you look at our overall profit and loss year to date, we are finally in the green for that. It was in the red for a long time, simply because of Riot mostly, because, it really dropped as soon as we got into our long position with it. But luckily this week we had a couple $400 days in the positive in our long positions, and it boosted us back up. Then everything dropped again, and then it luckily went back up, and so we ended up positive for the year for this week. Who knows what will happen tomorrow, but keep in mind that does not capture premium from the option plays that I do. So if I sell a covered call, that overall profit and loss year to date does not get captured. So this is just the long positions. That being said, I did end up rolling my Riot covered call. And if we go over to our sheet here, you can see I ended up buying that contract back. It would have expired this week, but I bought it back for a penny. So $1 total, because each contract is 100 shares. So I bought it back, and then I sold a new one for 33, which makes it obviously $32. Yeah, just gonna keep whittling that down. I think what I'm gonna do with Riot, I got to decide. I really think it's gonna shoot back up, especially once Bitcoin starts picking up again. And I don't want to miss out on my opportunity to get closer to even or make money off the capital gains. So I may end up buying this back out for a loss and just kind of wait, because the thing is a $19 call. It's at $16.50 right now, but this thing moves like 10% every day. So it's really not a big a stretch of the imagination to have this thing go to 19 this week alone and then, drop down to 12, honestly. But we could end up losing a lot, because it could shoot up back up to 30 overnight, honestly, and I really want to be there for that. So if I'm going to keep it, I need to just hold on to it and quit trying to milk out 1%, 2% returns when I would miss out on 100% returns, if that makes sense. Okay, so moving on. Next big thing we did was the Intel. We ended up rolling our covered call for Intel down and out. And the reason is because Intel, the stock is just not doing hot right now. They're spending a lot of money expanding and trying to position themselves to be an authority in the semiconductor space again. I think they're really scared about getting swept by the wayside with all these other companies. And yeah, they're trying to revamp their research. They're expanding, they're building factories, and that reflected in their earnings report. And Intel just dropped, but doesn't mean it's a bad company. People just react very strongly to that kind of thing. And so, yeah, we're going to hold on to our leap and keep selling covered calls on it. But I had the strike at 58, which was just way too far out there. So I bought that back for, I believe, $5. Yeah, $5, and then sold a new one for 58. So I made 53. And yeah, we're just going to keep whittling away. Hopefully by the time the leaps does expire, this cost basis will be zero. I doubt that that'll happen, but who knows? The reason I went ahead and rolled it out is there was really no point in waiting. That old covered call expired 22 of February, so I would have been waiting almost 20 days to capture $5. It just doesn't really make any sense when you can turn around, sell it, and you'll make way more money doing that because of theta and how it affects premium. All right. That is that. Getting into credit spreads. We actually did a lot this week. The first one we did was JBlue, which if we go to the chart here, click JBlue. Yeah, I ended up buying this on, I think, the 2nd of February. Yeah, the 2nd of February. and I bought it for an expiration of 18 March, so around 30 days, a little over 30 days, but RSI was right around 50. We have this thing going on with the MACD here. I thought it was going to cross over because it looked like it was, but then it's kind of staying flat, which is completely fine. As long as it doesn't drop a lot, then we're good. But yeah, we had the crossover, so I thought it was going. We were hitting the bottom of the Bollinger Band, so it just pretty much hit every metric. The only thing is the 20-day moving average crossed under the 50-day moving average, which I don't necessarily like, but because we had that crossover at the MACD here and we were having such good volume, I decided to go ahead and jump in with it. The next play that I did was one that I probably should not have done, honestly. And I went ahead and opened one up just because I'm kind of testing things right now. But I went ahead and did Robinhood. Now, I didn't really want to get into Robinhood because it's kind of like a meme stock right now, honestly. And the implied volatility is just really high. I mean, it's 100%. So it's kind of riskier. But the thing there's a resistance at around 10, right? And we had an uptrend on the MACD here. We had a crossover, and the relative strength is looking pretty solid. I'm hoping that continues to go up. But the main thing was the crossover and then the volume. The volume is above average. So I was hoping, because it hit the bottom of this Bollinger Band and we're so far away from the 200-day moving average, that it'll spike back up. The thing is like I said, this is kind of a meme stock, and a lot of people hate Robinhood and just want to see the stock plummet. So for good reasons, not good reasons, you can make up your own mind. However, there is that dynamic going into it, so it's kind of a riskier stock in my opinion, especially if we do something like credit spreads. I honestly think that by the end of this week, I'll have captured my profit goal, and I will get out of the position, and then I'll gauge it from there and see what I want to do. Now, I was also, if you remember, in SPY, I had a put credit spread on SPY. Luckily, we hit 75% profit for SPY, so I went ahead and closed it. Now, this is kind of a debate in the credit spread is, you open the credit spread, you get your max profit. Why would you cancel it when you still have money on the table? To me, it just doesn't make sense. The most we would have got was 60. But if you look here, 75% of 60 is 44. We ended up selling it for 46 and got 77%. Now, the thing is yes, I could have wrote it out for $14, but I would have had 20 days to wait to make $14 when I could capture the 46 that I made and then turn around and sell a new options play and generate way more because of data being what it is. And yeah, there's really no point. And then on top of that, we hit the 77%. And yes, we could have gone all the way to 100 if it would have 100% if it would have expired worthless, but it also could have dropped and we would have ended up losing a lot of money. The way that I was looking at it is I could make 14 more or lose 250 or 300 or whatever the risk that we had for that particular one was. Doesn't really make a lot of sense. $14 for $300, just common sense to me. The big thing though is, this is the really big debate with credit spreads, is I think going forward, anytime I open one, I am going to put a stop loss on it. And the biggest line of thought for that is I really want to avoid like a COVID crash, or like when the feds announced that they were going to be raising interest rates and then everything dropped. Now, if that happened right towards expiration and I had four, let's just say these four credit spreads open here, that means I would lose $1,200. Now, I'm only making anywhere from $50 to $100 per credit spread. So if I lost $1,200 in one go, it's not the worst thing in the world, and it actually is to be expected. But there's really just no point. And because I'm not selling credit spreads in the money, they're going to be like far out of the money anyway, then there's really no point in not putting a stop loss, because that will cap my losses. And if a spike or drop does happen, I'll be in a better position to have cash so I can make new plays or buy long positions for stocks on a discount. And that's where you make a lot of money, is when all that crazy stuff happens and you have cash sitting there, and then you buy stocks and then the market corrects and everything goes back up, but you've got all these stocks for a discount. All right, so that's going to be my strategy with that. Now, I also may be looking to open some iron condors soon. It's just kind of a weird time in the market right now. Everything's like really volatile, and I know I use that word a lot, but it kind of defines a lot of the strategies we use. I do think there are some opportunities for iron condors. Like I think the J Blue would have been an iron condor potential, but again, that's kind of like Robinhood airplane companies right now. It's real hit or miss because the news on a daily basis can affect the price of that, and I don't really like that much external pressure on something that I'm trying to keep in a defined range. Right, so the next thing is Levi. As soon as I get these shares called away, because I only want 100, I think instead of running covered calls on these, I'm actually going to do covered strangles. Now, basically all that is it's just a covered call and a cash secured put, which means if the stock were to drop a lot, then I would end up owning another 100 shares. But if that happened, then I would just sell covered calls at a really high delta to get back to the 100 shares that I actually want. The only thing that I have to figure out is how that's going to affect my maintenance requirement and my buying power. Because if it's going to double my buying power, the impact of my buying, then I don't necessarily want to do that, because I don't want my maintenance requirement to be really high up there, just in case anything crazy does happen. I think around this area, the $9,000 range for my account size is pretty decent. Now, I have to see how that all works, because it might not. I don't know the actual math behind it. I'm not even going to lie to you. So I'll see how much it does affect my maintenance requirement and everything, and then I may do that. Levi's just a really stable stock, and it's pretty easy to predict. I was planning on doing it with Ford too, but just this last week alone, Ford kind of threw me for a loop, because they had the whole EV announcement, and then they shot way up there, and then they dropped way back down, and that's not something I want in a strangle play. So it may be stocks that are just like really low IV that I do want to own long term, and they pay a dividend, and yeah, we'll see how that goes. I think that pretty much is gonna be it. The only other thing is just, if we look at our credit spreads, you can see we ended up making, I have it here, $362 just in a couple weeks. Now, keep in mind, I'm probably not going to realize all of that. It'll probably, hopefully, if everything goes to plan, it'll be around this, which would be $267. But that $267, just from cashing out at 75% of profit, is a 4.5% return on the $6,000 that we have set aside for options plays. And that just kind of shows you how quickly this stuff can start compounding, because like that SPY credit spread I sold, I think that was 4 days, and then I hit 75% and sold it. So obviously that's not like something we can bank on, but if we go on a huge run up in the market, I mean, we could have 6 credit spreads close out in 1 week where we lock in profits and open 6 more, and we could ride that wave up. And then as soon as it starts dropping, obviously, hopefully it doesn't drop too much. But yeah, I mean, it just shows you how quickly these can compound once you start getting into them, and how much money you can actually make. But anyway, yeah, that's going to be it, guys. Hope everybody had a good week. Hopefully you do well this week. and talk to you later.